Welcome to This Explainer. Today, we're going to unpack the architecture of the Canadian financial marketplace. Think of me as your guide to this incredible ecosystem. We'll be going from the big, macro-level concepts right down to the practical realities of how a single dollar actually flows from a saver's pocket to fuel a growing Canadian business. It's like a giant puzzle, and we're going to put the pieces together.
Our syllabus today covers 6 clear chapters. We'll start with the Canadian financial ecosystem, then look at the players and regulatory framework, essential financial instruments, exploring the financial markets, understanding formulas and yield, and finally, why the marketplace matters. Let's jump right in.
Chapter 1. The Canadian Financial Ecosystem, Connecting Savers and Borrowers.
Okay, so how does this whole thing work? Well, this marketplace is quite literally the engine of the Canadian economy. If we trace the flow of funds mapped out in Figure 1, we can see the step-by-step journey of capital. Think of a local entrepreneur. Maybe they run an independent coffee roaster here in Canada, and they want to expand into a larger facility. Where does the money come from? It starts with Step 1, savers. You deposit your paycheck into your checking account. Step 2, your bank acts as a financial intermediary, pooling your money with thousands of other Canadians. Step 3, that massive pool of capital enters the financial markets. And finally, Step 4, it reaches the borrowers. Our coffee roaster secures a loan, builds their new factory, and creates local jobs. That unbroken chain right there, that is the absolute heartbeat of economic growth.
Moving on to Chapter 2, Players and Regulatory Framework, the Architects of the System.
So who's actually operating and keeping an eye on this massive flow of funds we just talked about? Our marketplace relies on a triad of key players. First, we have investors, and that means everyday individuals like you and me, all the way up to massive institutional entities like pension funds, all looking to grow their wealth. Second, we have financial institutions. In Canada, we know this sector is famously dominated by the Big Five banks, working alongside credit unions and insurance companies to act as those vital intermediaries. And third, we have regulatory bodies, who are there to enforce the rules and keep the whole structure stable.
Now, here is a really interesting quirk about how Canada structures its oversight. Unlike a lot of other countries, Canada doesn't actually have one single national securities regulator. It's a team effort. At the federal level, the Office of the Superintendent of Financial Institutions, or OSFI, ensures our banks remain solvent. The Bank of Canada handles monetary policy and keeps an eye on inflation. But meanwhile, securities themselves are regulated at the provincial level, so places like the Ontario Securities Commission, or OSC, working to protect local consumers and stop systemic risks from taking root.
Chapter 3. Essential Financial Instruments, the Tools of the Trade.
All right, now that we know the players, let's look at the actual tools a Canadian business uses to raise capital or manage risk. But before we get into the weeds, let's establish a really clear definition. A financial instrument is simply a tradable asset. It represents either a contractual claim to future cash flows or outright ownership in an entity. So if you buy a company's stock, you literally own a piece of it. If you buy their bond, well, you hold a contractual claim requiring them to pay you back, with interest. Simple as that.
Another absolutely crucial concept for our entrepreneur and for any investor is liquidity. Liquidity just means the ease and speed with which an asset can be converted into cash without causing a huge drop in its value. Cash and treasury bills, highly liquid, you can spend them today. But what if our coffee roaster buys specialized, heavy-duty espresso machinery? That has incredibly low liquidity. It takes significant time and effort to find a specialized buyer and convert that equipment back into cash at a fair price.
Figure 2 brilliantly illustrates how we categorize these tools. You'll notice our small business owner basically has 4 main categories to choose from. They could issue equity, like stocks, which carry high risk but offer great growth potential. They might issue debt, like bonds, which offer a medium risk for reliable income. They might park their extra cash in the money market using low-risk treasury bills for maximum liquidity, or they might dive into high-risk derivatives like options and futures. For example, our coffee roaster might use derivatives to hedge against unpredictable spikes in the global price of coffee beans. It's all about picking the right tool for the job.
Let's dive into Chapter 4, Exploring the Financial Markets, where the trading happens.
We know the instruments now, but where are all these equities, bonds, and derivatives actually being bought and sold? First up, it is so crucial to understand the fundamental difference between the primary and secondary markets. The primary market is where a company issues brand new securities directly to investors to raise fresh funds. Think of an IPO, or initial public offering. But the secondary market, like the Toronto Stock Exchange, is where investors simply trade previously issued shares with one another. When you log into your brokerage account and buy a stock on the TSX, your money is actually going to another investor, not to the company itself.
And beyond the stock exchange, Canada hosts some incredibly diverse markets. We have equity and bond markets for raising capital, of course, but consider the foreign exchange or Forex market. Our local entrepreneur relies heavily on Forex to convert Canadian dollars to pay their international suppliers. And we definitely can't forget commodity markets. Since Canada is so incredibly resource-rich, the buying and selling of natural resources like oil, gas, metals, and agricultural products is a massive, massive driver of our national economy.
Chapter 5. Understanding Formulas and Yield, Measuring Success.
Okay, let's put on our analyst hats for a second. How do investors actually evaluate the performance of these financial assets? Well, the most common metric you run into is yield. Yield is simply the return you earn on an investment, typically expressed as a percentage of what it cost you, or its current market value. In the real world, this looks like the regular dividends you receive from holding a stock, or the interest payments you collect from a bond you're holding until maturity.
So, the crucial point is knowing the math behind it. Figure 3 shows the essential formulas you need, and don't worry, they're pretty straightforward. To find your return, you take your final value minus your initial investment and divide that by your initial investment. To find your yield, you take your annual income, divide it by the investment value, and multiply by 100. Let's say you invested your own money into that local coffee roaster we talked about. Calculating your yield tells you exactly how hard your capital is working for you on a yearly basis.
And finally, Chapter 6, Why the Marketplace Matters, the Big Picture.
To wrap things up, let's zoom back out to the macroeconomic level. Why does this entire complex ecosystem actually matter to everyday Canadians? Because it's not just about corporate balance sheets. The financial marketplace touches your life directly. It drives national economic growth and job creation. It creates personal wealth by offering you the investment opportunities that fund your RRSPs and TFSAs, so you can actually retire one day. Through strict regulation, it shields our economy from global shocks, and it acts as the vital bridge facilitating all our international trade.
But let's keep it real and build a realistic assessment of the system. Figure 4 balances the scales for us. On the advantages side, the marketplace offers incredibly efficient allocation of capital, a huge variety of investment opportunities, and brilliant risk diversification. But on the disadvantages side, participating in this market means exposing yourself to unavoidable realities. We're talking severe market volatility, interest rate fluctuations, the silent wealth killer of inflation, and frankly, the ever-increasing complexity of modern financial products.
As we look ahead, you should know that the Canadian financial landscape isn't standing still. It is rapidly evolving to tackle new challenges. We're seeing a massive wave of technological innovation driven by fintech. Think robo-advisors and blockchain, which make investing way easier but demand tighter cybersecurity. We're also witnessing a huge shift towards sustainable finance. Investors and regulators are increasingly prioritizing ESG, that's environmental, social, and governance factors, working to ensure capital flows toward responsible and equitable business practices. So, we've mapped out the entire architecture of the system today, from the provincial regulators all the way down to the mathematical formulas defining your yield. But the real question I want to leave you with is this. How will you use your new understanding of the Canadian financial marketplace to make smarter personal investments, or maybe even drive your own entrepreneurial success? Keep that in focus as you continue learning. Thank you so much for joining me for this explainer.